So in today's video, I'm going to explain a very common piece of market jargon plastered all over investment websites and analyst reports, and that's beta. Now, to give you an example, Glaxo has a beta, whatever that is, of 0.5. Apple has a beta of 1, and Rio Tinto, the mining stock, has a beta of nearly 2, rounded there slightly. So what are these numbers? When someone throws that at you, what's that supposed to tell you about these individual stocks? So today's video, what is beta? How can you use it? And what are some of the most fundamental drawbacks? Okay, for university graduates out there, this is not a mathematics module, so I'll be mentioning grand terms like regression analysis as we go along, but I'll save explaining that to another video altogether. Okay, so what is beta? In a nutshell, these numbers represent, or are supposed to represent, a risk. Beta, that's B-E-T-A, or that symbol, for Greek experts, is supposed to represent the risk of these individual securities. What does that mean? How do you measure riskiness? It means how sensitive are these stocks? How volatile are these stocks? And beta specifically says, what do these stocks do when benchmarked against the wider market of stocks? Do they move with the market? Do they move less than the market, low volatility, or do they move more than the market? And the market is often defined as, say, the S&P 500, if you're looking at the US, or a version of the FTSE. The 100 is a bit narrower, but you could take, for example, the FTSE All-Share. All right? So beta is a measure of how volatile a particular stock might be when measured against the rest of the market. Okay? Now the technique is called regression analysis. That's one of those terms that might have caused a few people to give up and have a cup of tea, but don't panic. Regression analysis is the way you get to these numbers for particular stocks. And by the way, this video I'm going to talk about stocks, but actually this can be applied to whole portfolios as well. But stock betas, the idea is simply this. Now this is a very quick and dirty guide to regression analysis, but essentially all it does to come up with a beta is this. All right, if that's time, if I was to plot, I'll make up the line, the S&P 500, that's the main index in the US market, okay, and let's say over a couple of years, so we've got year 1, year 2, it does something like this. All right, the market, this is just the convention, has a beta of 1. Okay, now you might have noticed when I had my stocks up that GlaxoSmithKline, the big pharmaceutical, had a beta of just 0.5. Apple, technology company, had a beta of just about 1, and Rio Tinto had a beta of twice the market. So what's going on there? What are they doing? How are we measuring this? Well, in a nutshell, this is regression analysis, really is distilled right down without any numbers. If you have a stock that pretty much tracks the market, give or take, then it also has a beta of 1, or near enough 1. So stocks that pretty much do what the market does, rise when it rises, fall when it falls, are given betas of around 1. Maybe not exactly 1, could be 0.96 or 1.05, but about 1. Okay? If, on the other hand, you have a stock that does this, sort of exaggerates what the market's doing, okay, Loch Ness Monster style, that would have a much higher beta, well over 1. All right, mining stocks tend to be quite volatile. Rio Tinto has a beta of 2. All right, so volatile stocks, and regression analysis, by the way, just calculates over a time period sort of what's happening to the distance between the stock line and the market line, if you like. But I won't go into the mathematics here. It's a technique you can use to consolidate all that information about stock prices against the market into one number. So high beta stocks move a lot more than the market. They're more volatile, okay? Think mining stocks and banks, for example. And you can have beta of less than 1. Regression analysis could spit out a beta of less than 1, and that would be a stock that actually is less volatile than the market. Okay, so it's actually not moving around even as much as the market. And that would be a beta of less than 1. All right, and for completeness, by the way, is it possible to have a negative beta? is it possible to have a stock, I won't mess up my diagram any further, that pretty much does the opposite of what the market's doing? So the market's going up, it's going down. Well, there are one or two inverse exchange traded fund type products around. There are one or two stocks around that do pretty much that. So you can even have a negative beta, right? And that means that the stock's returns are sort of the opposite of the market, if you like. Okay? So you have this number, beta. All right? It can be greater than 1, tends to suggest the volatile stocks that move around more than the market. Around 1, a stock that pretty much goes with the market, or almost is the market. And less than 1, less volatile. Okay? And if you're thinking of grouping stocks, now there's where my first slide makes a bit more sense, if you like. Mining stocks and banks tend to be highly volatile. Stating the obvious really, but when you see on an analyst report, Rio Tinto has a beta of 1.8. Okay, that's the number telling you you've got a stock that moves roughly 1.8 times the distance of the market. All right, so this is what it means. If you've got a beta of say 2, it means you have a stock that usually moves, looking at the past over say 2 years, using regression analysis, twice the distance of the market. What does that mean? So when the market rises 10%, it goes up 20%, beta of 2. When the market falls 10%, it drops 20%. Yeah? Whereas an Apple, that I mentioned, is moving with the market. So an Apple type stock with a beta of around 1, if the market goes up 10%, that stock will tend to rise 10%. So the market goes down 10%, it'll tend to fall 10%. And the low beta stocks, now I had GSK, GlaxoSmithKline up here, beta of less than 1. I said it had a beta of about a half, actually, if you remember that. That tends to suggest that if the market rises 10%, it'll just go up 5%, half the distance. If the market falls 10%, it'll tend to go down 5%. Okay? So beta is this kind of rough and ready measure of the sensitivity of a stock relative to the rest of the market. How risky is it? Now, how can you use that? Is that useful? Does that help quantifying that? Well, it can do. Here are 2 or 3 uses. Number 1, some people use it to predict a stock's returns relative to the market. So there are people out there who will say, well, Tim, if I have a stock with a beta of 1.2 and the S&P 500, that's the US index, goes up 10%, if that's what I think is going to happen, then I could expect whatever this stock is to go up by 12%, 1.2 times 10%. So you can sort of use it, and people do sometimes use it in that way, as a predictive tool. Okay? Secondly, here's a very, very blunt strategy. When the market's rising, some people would say you want high beta stocks because they're the ones that are going to overshoot. They're the ones that are really going to pay back. When the market's falling, on the other hand, you want low beta stocks. You want the ones that are dragging the market, not falling as fast. Okay? Translate that into investment speak. There is no argument that says when the market's rising, you want to buy cyclical stocks, the miners, the banks. When the market's falling, you want to be in more defensive areas. Maybe if that's pharmaceuticals, for example, or utility companies, okay, tend to have lower betas. And the third use is diversification. That's a video in its own right, but you do take a risk. If your portfolio is packed with high beta stocks, you are going to suffer when the market falls off a cliff because they're all going to plunge like lemmings, okay? So a diversifier would say, well, I don't want a portfolio stuffed full of high beta stocks. I kind of need to balance it out a bit, okay? So takes you into kind of the theory of diversification, which I'll cover in another video. Now, it all sounds brilliant so far, so I can use it to predict how stocks will perform, I can use it to spread my risk via diversification, I can use it to work out whether I need to be in cyclical stocks or defensive stocks and capitalize on market movements. Sounds too good to be true, and that's because it is. All right? You have to be careful with beta. Here are just 2 or 3 big criticisms of beta as a predictive tool as to what stocks will do next. Number 1, it's historic. You look backwards to calculate it. Don't worry about how regression analysis works, how I got that sensitivity number of 0.51 or 2, but the point is you're looking backwards. Okay? You're saying that, well, over the last 2 years, GlaxoSmithKline has appeared to behave this way, so I'm going to use that to predict what it'll do next, and that's always dangerous. The past isn't necessarily a guide to the future. Okay? Secondly, there are different ways to calculate it. I mean, why did I look on my graph at 2 years of historic data for the shares I was drawing? Why not 5? Why not 10? Okay? And the answer is, there is no right answer. Should I look at longer than 2 years? Should I go back further? And opinion divides on that subject. And that's why, if you look at betas from different suppliers of market data, they won't always be the same. good reliable suppliers include like Reuters, Bloomberg and so on, but you won't always find that the beta number agrees if you look at two different sites for one stock. Okay? And thirdly, beta only looks at one thing. It's the stock's risk relative to what the rest of the market is doing. Okay, it doesn't really tell you much about the sector, for example. Isn't it more relevant to know what Rio Tinto is doing against other miners? Because maybe there are miner-specific issues, new legislation or permits or licensing issues out there that need to be factored in, okay, to make the number more useful. So, people look at beta and think, brilliant, it's this kind of magic number. And it's an easy number. It's a small number, like 2, so I can use it to predict that my stock will give me twice the return of the market, and they forget that actually that very simple looking number is the result of a lot of number crunching, a lot of assumptions, and not all of those assumptions are strictly speaking valid. Okay? So by all means, take a look at a stock's beta. By all means, use it as a rough and ready guide to how volatile the stock might be. But as with all single numbers that look like they offer that kind of holy grail of, great, this is the number I can rely on, don't do it. To download this free video to your favourite mobile device, find us on iTunes by searching for MoneyWeek. And the entire video archive is also available free. Just visit moneyweek.com.
Are you looking for ways to get an edge on the market? Are you trying to grow your retirement account into a few million so that you can retire comfortably? Or are you trying to take a few thousand and grow it into many millions through more aggressive investments? Hi, I'm Dr. Scott Brown. I hold a PhD in finance and I'm a professor of investments in a major state university. I prepare our brightest young minds in our MBA program for jobs on Wall Street, Tokyo, New York, Chicago, our major financial centers around the world. My former MBA students manage portfolios in Fortune 500 companies ranging from Merrill Lynch through Bank of America into State Street. And I also train the banking executives so many people love to hate today. Well, if you can't beat them, you might as well join them. I've packaged all of my MBA material and much, much more into 4 curriculum tracks in a very easy to comprehend and understand language that allows you to master the intuition behind all of the techniques used to generate the highest possible returns in the world today. The first track is stock and options. Let's face it, every family today has to understand how to trade stocks or invest in stocks. Corporations have taken pensions away from families today and given the 401k back in return, where you're expected to understand how to manage stock portfolios but don't have such training to do so. You'll also learn how to purchase the same stock at a quarter or less of the cost and quadruple your returns through options. Once I have you mastering stock options, it's an easy leap over the fence to futures options. The second track is commodities and financial futures. These are markets that have created millionaires out of a few thousand in seed capital. But you won't be trading your retirement accounts in these markets. You'll be taking a tiny grub stake of a few $1,000s you can afford to lose that won't affect your current lifestyle. And you'll try to turn that tiny amount of money into a large fortune. These fast-paced markets can build your wealth with astounding speed, but they can also tear away every penny just as fast. I teach you the safest possible ways to teach these fast and furious, highly levered markets. In fact, one feature that distinguishes my program from others is that I show you how to segregate the money that you're making today so that you can figure out to the penny what that tiny grub stake is that you can risk without losing your current lifestyle. The rest of the money, the vast majority of the money, you learn how to put into extremely safe, set it and forget it investments. The third track is Forex. This gargantuan market has produced more billionaires than any other I know. And you'll learn more with me about currency trading than the vast majority of people know working on Wall Street. The fourth is an intensive combined curriculum teaching you all of these markets at once. That's stocks, stock options, futures, futures options, Forex, and currency options in a way that teaches you to become a well-balanced, controlled leverage investor. But the icing on the cake is the live trading rooms, where I trade my actual account. I put my hard-earned cash on the line, and you see inside my 3 major investment accounts. You see inside my stock trading account, you can see inside my futures trading account, and you see inside my Forex trading account. You get to see me enter and exit the market, place trades, and you get to ask me questions in real live time. No other guru has ever had the cojones to trade his or her account in front of a live student audience. You do. It was terrifying when I first started trading live in front of my students, but I'd come to the conviction that it was the only way that I could truly teach you. I want to extend my personal welcome to our community of like-minded individuals who are investing their way to a more comfortable lifestyle. Click on the link below, and I'll see you soon in the live trading rooms.
Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap where we're actually going to go over both the trades from yesterday on Monday the 19th and also today, Tuesday the 19th, which is actually my birthday. And again, just like I had said the other night, we're still having a little bit of internet issues, so I'm actually recording this at a coffee shop down the street because I can get a little bit better service. Hopefully everything should be back to normal maybe tomorrow or Thursday as far as the velocity of these videos coming out. So, but again, we'll always post the videos, talks about all the trades. Never have to worry about that. We'll always get to it, just might not get to it as soon as we like, at least right now with the whole move and everything going on. But I do want to get over the trades we made yesterday and then the one trade we made today because a lot of it was adjustments. So before we get into the adjustments for Netflix and Yahoo, I wanted to just briefly talk about our closing trade in XOM. And I think this one's really important because it really highlights this whole idea that we've been working with constantly about picking the right strategies in the right market, right? Using the right tools for the right opportunity and not trying to force round pegs into a square hole, if you will, trying to force the same old strategy into the same old market situation, whatever the case is. And I say it all the time on my coachings, but strategy selection is one of the key definers between and what I believe to be good traders and bad traders, right? Is the ability to look at a market and choose the right strategy. And we talk a lot about it here on the videos. We talk a lot about it on the blog. We're going to be talking a ton about it on the upcoming podcast as I'm starting to get that stuff ready to go for you guys. So we're going to be continuing to drive home this point. But today, ExxonMobil really drives home the point because the stock really didn't move anywhere, and yet we made money on this trade. So the trade that we closed out of was our short vertical credit spread that we originally had. We originally sold the 95 and bought the 92.5 strikes. So by closing out this trade, we are now buying the 95 to close out and selling the 92.5 to close out the trade. So that's the actual logistics and the mechanics of the trade. We ended up paying a 20-cent debit, but again, we taking off at our profit targets of making over 50%, about 75% or so, of our max potential profit in this trade. So we sold this for originally 48 cents as far as a credit, bought it back today for 20-cent debit, so we made $28 on each of these. Right, but the whole idea here is that with this trade, you'll look at the chart of ExxonMobil, and from the time that we actually sold this, which it was a couple weeks ago, it was kind of in this time period. I don't know the exact day, but I mean, you'll look at the stock, and the stock has gone nowhere. I mean, it's, okay, ever so slightly moved higher, but basically the stock has gone nowhere. There's been days where it's gone down. There's been days where it's gone a little bit higher. More or less, the stock has moved less than half a dollar, which for a $100 stock is practically nothing. That's almost less than like 0.25% for the stock. So it's really moved very minimal. Now, what has moved, and this is the key driver as to why we were able to take profits, is implied volatility. When we entered this trade, implied volatility for Exxon was over that 50th percentile that we talk about so many times here at Option Alpha, and it's in our strategy guides, in our blog posts. It's going to be a big topic again on the podcast I'm starting to fill up for you guys. But now implied volatility for Exxon has come down to 2%. So with implied volatility dropping, the stock had to move absolutely nowhere, and we were able to take a profit on this trade. So again, just a really good case study on why you make trades that are the right side of volatility now. And so everything happened that we wanted to happen. Could we wait for a little bit more of a move higher in Exxon? Sure, but again, we don't know where the stock is going. So we played volatility. That's what we generally do as option sellers. And we made some money, so you just got to get out of the trade. All right, so the two trades that we had as adjustments, the first one is Netflix. These are both trades, Netflix and Exxon were both trades that we made yesterday on Monday. Now, Netflix is a little interesting because we have we have a debit put spread in Netflix, assuming that the stock was going to go down. And we didn't get rid of that position. So this position that we added, which was a credit put spread, a very wide credit put spread, actually is a position that we're adding to our current debit put spread. So I'm going to go over all the details with the Analyze tab. I know a lot of you guys love that stuff. I'm definitely going to go over all those. But the actual logistics of what we did is we went back in and sold the September 430, 460 credit put spread. I know this is very, very wide, and I'll talk about it in a minute as to why we did this very, very wide. There's rationale behind this, obviously. But we went in and sold the 435 put options and then bought really, really far out of the money 360 put options, and that gave us an overall credit of 372. So that basically gives us a synthetic short put position in Netflix, which helps reduce our cost basis on this trade should Netflix continue to move higher. Okay, so what does that all mean? So let's go in here and let's just take a look at Netflix as far as the chart, and you can see that the stock obviously has continued to move higher, right? Against our debit put spread, we want Netflix to go down, and look, we've got a lot of time between now and expiration. This stock can easily turn around. This is a very fast-moving stock. You'll notice even last month, the stock really jumped middle of the month and then continued to move lower. So there's no telling what this stock can do. And a lot of people think, oh, it's moving higher. It's going to move higher for the rest of the month. I can show you guys a million examples of stocks that didn't do that. But in case it doesn't, this is why we have made this position and this hedge, at least for the short term. So we go in here to our Analyze tab, and this is what our profit loss diagram looks like currently before the hedge was applied. So before the hedge was applied, we had a very simple debit put spread. I know I can't draw right on those lines, but a very simple debit put spread, the 425, 430. And you'll notice Netflix is actually trading all the way up here. It's at 468. So very, very deep in the money put spread. And that put spread is actually losing a lot of money, right? Now, originally, had we done nothing to this trade, we would have lost at expiration about $514, as it currently stood Monday before we made this adjustment. Now, I don't know about you, but we talk a lot about on the site here, managing trades that go against us. And yes, we close out trades like we did in Exxon, and we kind of briefly go over those because they're winning trades. You go over them, they're winning trades, they're easy, it made a profit, and you close it out. And we do that all month long until we get trades like this, and this is a good learning example as to what we do to help mitigate some of the risk of trades that go against you. So the base case study here is that if we do nothing, which is what 99% of traders do, is they take a trade that goes against them and they say, oh, well, I'm going to lose $514 on this trade. So what? They close it out and move on. Now what we did is we added a synthetic short put option. So I'm going to add both of these options in here, and it kind of creates a basically synthetic put option in Netflix. So now we have still a loss here if Netflix does nothing, but our loss is really capped all the way until Netflix gets down to about 425, and then we start really losing more money. So we've got pretty much capped loss. Netflix can really go much, much higher than here. It doesn't really hurt our position at all, so this is why this hedge works. But in the worst case scenario, or not in the best case scenario, at least right now, if Netflix does continue higher, rather than lose $514, our max loss has now been cut with just this one adjustment down to $142. And that's if nothing happens, Netflix stays here, or even goes lower down to like 430, 420. Our max loss stays at 142. And again, I don't know if this is exactly what you guys really want, but I get a lot of questions from people saying, Kirk, how do you reduce losses on trades? How do you adjust it? This is the essence of trading right here, is taking a trade that is going to lose $500+ and making an adjustment so that it only loses $142. And I bet you can think back on a couple times where you had really, really big losses and said, you know what, if I could just cut that loss in half, I'd be happy. Or if I could just, save $100 or $150 on that trade, I'd be happy. Well, in this case, we're cutting it from 514 down to 142, right? And we're not done yet. We have many more adjustments that we can make on top of this to make this a profitable trade. But really, in kind of the base scenario now, we have this loss down to $142 if Netflix continues to move higher. Now, what's really, really key about this particular trade is how we did it with this wide credit spread, right? Why did we do a wide credit spread? Well, the reason that we did this is because we wanted a big premium, right? And we wanted a big premium, so we wanted to go ahead and sell the 435s. That was our first strike, is to sell those 435s. But just selling those 435s naked gave us a lot of margin usage. So the broker really hit us for margin because we're selling a put option naked on a stock that's worth $435. So again, selling that naked option gave us a lot of margin usage. I mean, the brokerage in Thinkorswim wanted to take a lot of margin out of our account and use that margin to cover this position, and rightfully so. We're selling options naked on a stock that's $435. There's a lot of downside room. So what we decided to do instead was still sell that option, but to go really far out of the money to an option that has some value, right? It's got some value of about $30 or so, and buy this option and create a very wide credit spread. So that's exactly what we did. So we went further out of the money, made this thing really wide, but by buying this option here at 360, even though we paid only $30 for it, we assume that it's never going to make any money. That $30 freed up a ton of our margin exposure from Thinkorswim. So we got back, I think it was like over 60% of the margin that they wanted to take for just selling the naked option. So this is really a key differentiator between some traders, is that using just strategies like this where you're just kind of looking at margin a different way, looking at your capital usage. We could have easily sold the 435, covered the margin, collected an extra $30. But to me, it's worth keeping some of that margin intact and not letting the broker use a lot of that margin by just going out here and buying this out of the money option and making this a very, very wide credit spread. So if I go back now to the Analyze tab and kind of scroll all the way over here, now you see that all the way out on this further edge, now we have this part out here at 360 where our profit and loss line kind of flatlines. So if Netflix was to absolutely crash, we still have risk-defined trade here. It'd be about $7,000 loss, which we obviously don't want, but that's if Netflix was to absolutely and emphatically crash between now and September expiration. So hopefully that's a good insight as to where our position is in Netflix. Again, we really are only going to lose 142 currently if we make no other adjustments, which I definitely plan to make more adjustments. Maybe roll up this put side if Netflix continues higher, add a call side to this trade. There's a lot of different things that we can work with. But for now, we're just going to let Netflix kind of work itself out and see where it goes over the next week or so before we make any adjustments. Okay, so kind of beat a dead horse there with Netflix. But again, this is what you guys want. This is what I'm delivering as far as education and teaching you guys what we're doing here to reduce loss and increase our gains and income each month. Now, the next adjustment that we make is a very simple adjustment, so I'm not going to cover it too much in depth because we made it a number of times before. But this is our trade in Yahoo. So we originally had a call credit spread in Yahoo. So we had sold a credit spread above the market, assuming Yahoo would go down or implied volatility would go down. And now Yahoo is kind of banging on the doorstep of our short strike on the top side. So what we did is went back in here and sold a credit put spread against that position to create an iron condor in Yahoo. So we went in and sold the 35-34 credit put spread. So we sold the 35 options, bought the 34 options, and took in a credit of 27 cents. Now, what I love about this position and doing this with some of your vertical spreads is that it does two things. It, one, minimizes your overall loss. So because we matched up the width of the strikes, which is $1, and we did the same number of contracts on the put side as we did on the call side, we absolutely emphatically cannot lose more money than we did before. In fact, we can only lose less money. So it reduces our overall risk because we took in a credit. The second thing is that because we took in a credit of 27 cents, it also increases our potential gain. So if Yahoo does turn around in the next couple of days and weeks and actually settles into this range that we've kind of range bounded with this iron condor, then we actually stand to make much more money than we are actually putting at risk right now. So really good adjustment to trades is to make this trade in Yahoo. And I'll go to the risk diagram here so you guys can see it. And let me just actually take off this put side trade so you can see what the call side trade looks like right now. So this is what it looked like before we made this adjustment today. Again, we have the 38.39 credit call spread, and notice that Yahoo is trading right at 37.83. So it's really getting close to our short strike and starting to go into the money. So again, rather than let this thing go all the way higher, lose $296 if it goes all the way beyond 39, we went back in and sold the 35.34 credit put spread. So now we have this iron condor that still we would like Yahoo to continue to move lower, right? And we'll adjust up this put side if we need to continue to move it higher if Yahoo trades higher. But right now, it's still about 30 days to go till expiration. We want to give Yahoo some time to move back inside this range and start to materialize a profit. But the key here is that now our max potential gain is almost $212, and our loss has been cut down to 188 in the worst case scenario if we made no other adjustments to this position right now as it stands. So it gives us a really good idea of how you can adjust these credit spreads, create an iron condor out of it. What I did want to show you guys is I want to show you exactly where we place that position as far as probability. So right here below, you'll notice that where we actually placed that put spread position was right at about the 75% probability level. It's gone down just a little bit after the close here, or during the day between the time we made it and now. But we placed that first strike right at the 75% probability level because we still want to potentially make money on this trade. So we want to adjust this strategy with a high probability put side. So we didn't get too close. We didn't come in here to 37 or 36. Again, there's still about 30 days to go in expiration, so we want to give Yahoo a nice little window here between 35 and 38 to trade for us to make money. If I go to the chart here of Yahoo, just to kind of wrap it up, you guys can see that the window of opportunity is between 35 and 38. So we definitely still want Yahoo to continue to move lower, but if it does move higher, then what we'll do is we'll just roll up this 35 up to maybe 36, or up to maybe 37, something like that. We'll just roll it closer, take in more credit, reduce our risk on this trade. And that's exactly what the essence of trading is. And I go over it all the time with people. And really, I hope this video kind of helps with that as well with these adjustments. So as always, if you guys have any questions at all about these trades that we made, please let me know. Add them in the comment section below. I'll get back to all of those tonight or tomorrow before the open, and happy trading.